Hello, everyone, and welcome to BFW 2401, week 4, part 4. This is the last part, and we have only 15 slides, but we will deal only with two or three concepts. We will deal with what we call the share market data as part of our full framework of bank performance analysis. We talked about the financial analysis, we talked about the qualitative and the quantitative, and now we are moving to the share market data and its analysis. We have also talked about the new measures, which I talked to you before, which is the dealing with the economic profit. So if you allow me now, let me just share my data and I will start. So this is actually part 4. And we are talking here about the share market data. So we are talking about shareholders' return. Now, the shareholder return, we start with the concept of the price-earning ratio. Price-earning ratio is one of the most important ratios to evaluate banks. And when this ratio is, when the price to the earning is high, that means there is a potential, as I will explain in a minute now. Now, share price divided by bank earnings per share. So we know that the earning is actually the EPS, which is earnings per share. The net income divided by the outstanding shares. Now, the most interesting thing here, if the BE, which is the price to earning of a bank or a company comparing to the others, is higher, that means there is a potential for this, for the growth, and the investors are saying they are saying something in the bank or in that company, which make them pay more for the price now, for the share price, and this is why this this ratio is increasing. Let me give you this example. Assuming that you have two banks, Bank A and Bank B. Now, Bank A and Bank B, as of now, you know the share price for Bank A is 10 and the earning per share is 1. So I understand the BE is 10 to 1. Now, when we talk about earning per share, as I told you, it's the net income over the outstanding shares. Bank B is the same thing from the perspective of the investors, because you will have the share price if you have 20 and they are making $2 per share. So actually you still look at earning per share is actually 10 to 1 or 20 to 2. So we say 10 to 1. If suddenly in the second year, this bank price still paying 1, and this is still this still paying 1, and this is still paying 2 for the price of 20. But this price suddenly also they are paying 1. The price is going to 15. Now the PE is actually becoming now in the second year 15 to 1, while this is still 10 to 1. So what happened is actually also the customers now they will earn only here 1 and here is 1, which is the earning per share, but they see something in the bank, in Bank A, that is growing in the future. And this is why they are willing to pay now 15, expecting a growth and expecting the earning per share to be higher in the future. So this is, sorry. So this is the first concept. The second concept is, I think you know this, the shareholders return. Now the shareholders return, when we get return, we get either a dividends when we invest or capital gain. And this is very important to see how much the bank is offering its shareholders, how much return it's offering its shareholders. So, so it's dividends and capital gain. So the shareholders return is actually both. Let's take this example. If you have a bank that has share price at the beginning of the year is 21, they pay the share price at the end of the period is 25, and they pay end of the year 1.20. So actually from the perspective of the shareholders, the dividends was 120 over the 21, which is they get 5.7%. And then they also achieved a capital gain when the price jumped from 21 to 25. So they are making 19%. So actually the total they are making is the 5.7% or and the 19%, which means actually if you look to this formula, you will find that 24%. So this is actually the total, the shareholders return coming from the capital gain and coming from the dividends. Let me move to some other issue, which is the growth. Now, this data, assume I take it actually from the data in part 3, when we have the total asset for the bank in 2019 was 130 and growth to 1335. This is the total assets. So you can actually calculate the growth, which is 2.7%, and you can compare this growth to the other growth in the industry and ask whether the growth was compared to GDP. Maybe the whole country is growing and the GDP growth is increasing. So the economy is increasing and banks is one of those, the growth is impacted actually by the economy. And what about when we take the peer and the trend analysis, we want to see our growth up, comparing to last year and our growth comparing to our peers. If high or low growth, does this reflect more or less risk taking? Does it reflect more or less market share? So we have also to ask our questions when we are growing, which means giving more assets. Is those assets are okay? They have quality? Is it quality lending, quality loans, or is it just more and more loans to increase this growth? And so we have to look at the risk. And also, if we know that the growth actually is real, we have to compare this to the market share. If we are increasing our market share, that means actually we are also growing. So the market share is another issue, and you can compare your assets to the total assets of the banks, because in our example, we don't have the total assets of the banks. If we know it, we will see how much the growth in 2020 and compare it, how much our share in 2020, and of course, we will compare it to 2019. So you take your total assets, comparing to the total assets of the whole banking system, and see how much you are, how much is your share and from the total market, which means your share of the market, in the loan market, in the housing market, you would see how much is your share in the banking system. Now, if you are gaining or losing market share, you have to know why. If you are gaining, has it both market share? Are you sacrificing margins, which means are you giving more assets with more risk, or maybe you are decreasing your cost and your prices for the interest rate and getting more and more customers and giving more loans on the expense of the return, which means you are giving just cheap loans. Can do similar assessment for market share, and we have to do similar assessment of market share of loan segments and deposits. So you have to do the to see the market, the total market share for the assets, and you can do it for the deposits, and you continue like this, because down here we use the total assets, but we can use also the total deposits, which means how many people actually are depositing with us, because you can give loans from so many places, including issuing bonds or borrowing from other banks, not only from the depositors. Now, let me move to the new approaches. As I told you, new approaches, they are measuring performance. And we have two of them. We actually, it's the EB, which is the economic profit, and the RORAC, which is the risk-adjusted return on capital. I will show you how this AB works, because when we make profit, our profit, when we make revenues, our revenues should cover our cost first. And our cost, actually, the admin cost and all these costs, including the cost to the depositors. After that, we will have a net income. Now, this net income, we will pay it as dividends. And this dividends should be equal to the required rate of return by the investors or the shareholders. If I gave them the required return, according to the market rate, so the ROE, which they are asking for, they are getting the full, for example, if they are investing and the required rate of return is 10%, I'm giving them that 10%, and they still have surplus. Now, in this case, which means we are making more than my cost to depositors and my cost to the capital. And they still have surplus, which means this bank is going to grow. So please understand it from this perspective. Look at this, for example. So what we call the economic added value, which is, and this is what leads to the bank's growth. It's the net income. We know the net income minus the expected losses, loan losses. So if we get the net income and we deduct it from the expected loan losses, like provisions and all these issues, then we have to decrease the cost of capital. If we still have, if it is positive, if this number is still positive, then in this case, we are making some, what we call economic added value and economic profit. This is a risk-adjusted measure, because now look, when you take the net income and you take the expected loan losses, this expected loan losses is according to the risk of those loans, and then you decrease it from the cost of capital, because more risk needs more capital. More risky loans need more capital. This is a basic thing. So the allocated capital for this type of loans, if you still make profit out of it, then you still make plus, then you are actually making what we call economic added value. So this is a risk-adjusted measure, as the amount of allocated capital depends on the risk, which is this area. So more risky business must allocate more capital. Expected loan losses are deducted from the net income. So you take the net income and you take the expected losses, and the cost of capital is actually the capital for the unexpected losses. So the higher the risk of a loan, the higher is this one, and therefore this formula should be fair to show how the economic added value, to measure the economic added value. Look at this example. If you have a bank, pre-tax cost of capital is 30%. Loan A is risky and needs $8 of capital. Loan B is low risk and needs 4% of capital, which means actually loan B is less risk. Let's take the cost of capital for loan A, which is 30% of the 8, which is 2.40. Loan B needs just 1.20. Now, loan A will add to the shareholders' value of its net income minus expected loan losses is more than 1.240, which means if I cover this cost, if I cover the cost of capital, which is actually risky because I'm evaluating loans and segments in the business according to that, if I cover the expected losses and the capital required, depends on the risk, because the capital actually will cover any unexpected losses. So if I still able to get a plus or a positive value after I detect the cost of capital according to the risk of that loan and the expected losses of the loan, that means I'm making economic profit and growing. The same thing, but the same thing in B, because in B, when I achieve value, when net income minus the expected losses still over 120, which means I still have an economic value after I cover my cost of capital. This is actually the RORAC, the economic add value. Now the risk adjusted asset is a little bit different. So we will have the net income and the expected loan losses and divided by allocated capital. It will give me a percentage here. It will give me here a percentage. Now this percentage, it will give me here a percentage. Anyway, this will be some type of percentage. Now this percentage, if it is more than so if this percent, which whatever it is actually more than the ROE, which is the cost of equity or the cost of capital, I have a positive, then this is actually a good loan and I'm making an economic profit. So as you can see, I'm dividing the net income over the allocated capital. So that will tell me how much the income to the capital. If it is of course, after taking into consideration the expected losses, this is the net income after all those. So this numerator is after you deduct everything. You divide it by the allocated capital, you see this percentage. If it is higher than the ROE or the cost of capital, then we are making actually a profit. So here, if the RORAC required rate of return capital, then the bank is earning economic profit and increasing shareholders' value, which means the bank is growing. I think I am done. So this is just recapping for what we say. The performance analysis has to be, you have to get qualifying data. This is just to recap what we said in the 4 parts. Verify the data quality, ratio analysis, share market data, other measures for return risk of balance sheet, qualitative. You have to do all of those things to get actually good analysis. Now, good financial analysis has to take into consideration comparing with their peers, the trend, and drilling down to discover why ratios change and look for linkages. Okay. This is the whole thing. I just want to share with you this one. Maybe I will not test you on this issue, but this is to tell you how the banks measure the interest rate. So, I mean, their cost of interest rate. So we have what we call the risk yield curve. Now, this is the risk-free of the central bank. If you look from year 1 to year 5, as we know in finance, when we go long run, interest rates and return is higher than the short term because of the liquidity preferences and because of what we call maturity risk. So maturity risk, when you give a bond for 30 years, it's different from when you invest for 6 months. You don't know what will happen in the next 30 years. And this is why the return increasing over time. This is the risk-free. So the risk-free, if you invest in T-bill in the US for 10 years, is different from when you take a treasury bill for 90 days. So the rates are actually different. So this difference is actually the maturity, which is coming here. So this is the maturity. This is the maturity. And this is actually for credit risk. Let me just so this is actually the this area, all this area from here to here. This is the spread for the maturity, the spread for the maturity. But now this is because there is no credit risk when we invest in government securities. Credit risk is out of our calculation because the government never default. But now when we give a corporate loans, now there is a possibility that they will default. So I have to take into consideration this, and I have to add my credit risk, which is 1.5. So as you can see, when government security return for long-term is 6%, mine is 7.5. Why this 1.5 is coming to the picture? It's the credit risk spread. Okay, this is one thing. Look on the short term now. In the short term, for example, if I borrow CDs, and the customer, the issuer of the investors of those CDs, the investors who buy from me these CDs, they will ask for 3.5. But if the risk-free is 3.0, why they are asking this 0.5 is actually the spread of the funding, the spread of borrowing in this case. So actually, if you look at the thing that I want to say here, that there is two spreads, one for maturity and one for credit risk. And this spread increase over years. Which one? The maturity, but the credit risk still the same. That's all I want to say for today. I think I am done, and this is the end of part 4. And thank you very much. Let me stop sharing, and I will see you in the next recording. I mean, for week 5. Bye-bye.